There was a time when Dish Network shifted millions of Americans from cable to satellite TV. In the early 2000s, those satellite dishes were everywhere, on rooftops, on balconies, or even on yards. Back in 2016, they were flying high with a stock price of around $80 and over 13 million subscribers. And cable giants like Comcast were on a real run for the money. But today, you don't usually see those dish satellites around you. Now, it's hard to believe we're talking about the same company. Their stock has nosedived to just $5. They've lost over half their subscribers, and they're buried under nearly $30 billion in debt. This isn't just a story of cord cutting, it's a full-blown collapse. So what really went wrong with Dish? And why is this being called one of the most dramatic downfalls in recent telecom history? Let's find out. Well, Dish Network's story begins with a man named Charlie Ergen. He was a bold, risk-taking entrepreneur with a background in poker. He started the company in 1980, and in the early days, they were simply selling large, bulky satellite dishes to people who wanted more than just basic cable. However, things began to shift in the mid-1990s. In 1996, Dish launched its first satellite and officially entered the satellite TV business. That was the first turning point for the company. Unlike traditional cable companies that relied on physical wires and mostly operated in cities and suburbs, Dish had a key advantage. It could reach anyone with a clear view of the sky. As a result, they were able to deliver TV to people living in rural areas, small towns, and other places where cable couldn't easily go. Apart from that, they offered hundreds of channels, useful features like the Hopper DVR, which even lets you skip commercials, and lower prices that gave big cable companies a big challenge. By 2016, Dish had grown into the second-largest pay TV provider in the U.S., sitting right behind Comcast with 13.7 million subscribers. To stay ahead of the curve, they also launched Sling TV in 2015. It was one of the first live streaming services, which showed they were willing to embrace change and lead in a fast-evolving market. But Charlie Ergen wasn't just focused on television. He had a much bigger vision for the company. Over time, he began buying up wireless spectrum, essentially the invisible space that carries mobile signals, because he believed Dish could eventually become a major player in the wireless industry. It looked like Dish was well on its way to becoming much more than just a satellite TV provider. However, that big dream of turning Dish into more than just a TV company is where things began to unravel. The company made a series of bold decisions that, in retrospect, seemed more like high-risk moves than carefully planned strategies. The most significant of these was their shift into the wireless industry. Since 2008, Dish has spent over $25 billion acquiring wireless spectrum, essentially the invisible space required to build a 5G network and compete with established players like AT&T and Verizon. Building a 5G network, however, is not only extremely costly, but also highly complex. It involves setting up thousands of towers, investing in infrastructure, hiring specialized engineers, and maintaining constant technological upgrades. Dish did not have the cash flow to keep up with the pace, and the situation was made worse by strict FCC deadlines, which required them to use the spectrum within a certain time frame or risk losing it. By 2025, they had managed to cover only about 75% of the U.S. population, and the remaining gap became harder to close. This massive investment in 5G also diverted financial resources and focus away from their core television business, which began to decline as a result. At the same time, the company started facing challenges with its subscriber base. Over the years, Dish developed a reputation for frequent carriage disputes, disagreements with channel providers over contract terms. These disputes often led to channel blackouts, which obviously frustrated a big customer base. One notable instance occurred in 2020 when a conflict with Nexstar Media resulted in more than 160 local channels going offline for several weeks. Viewers were unable to access local news, sports, and other popular programming, which basically diverted them to switch to streaming platforms such as Hulu or YouTube TV. Further issues arose in 2021 when Dish decided to drop regional sports networks, which carried local NBA, MLB, and NHL games. This decision, although financially beneficial in the short term, alienated a significant portion of their loyal sports audience. Between 2018 and 2025, Dish lost over 36% of its subscribers, with hundreds of thousands leaving each quarter. Meanwhile, Sling TV, their early attempt at entering the streaming market, failed to deliver on its initial promise. Although it launched before many of its competitors, Dish did not invest enough in its development. While platforms like Netflix, Disney+, and Amazon Prime continuously improved their content libraries and user experiences, Sling struggled to keep up. Dish's primary focus on 5G meant Sling was left without the attention and investment it needed to grow. In 2023, Dish merged with EchoStar, its sister company. The goal was to stabilize its financial position, but the merger ended up adding more debt and making the company's structure even more complicated. By 2025, Dish missed a $326 million interest payment and failed to repay $2 billion in bonds that were due just months earlier. Altogether, these challenges, from overextending into 5G and losing customer trust, to neglecting their streaming platform and accumulating unsustainable debt, transformed Dish from a once promising industry leader into a company struggling to stay afloat. As of July 2025, Dish Network is in a deeply fragile position. Their subscriber base has dropped significantly, now standing at 8.07 million, 6.08 million from satellite TV, and around 2 million from Sling TV. This marks a steep decline from their peak of 13.7 million. Financially, the company is under severe pressure. In the first quarter alone, they reported a net loss of $107.4 million, while revenues fell by 8.5% to $4 billion. Meanwhile, their debt has reached $30.1 billion, becoming a serious burden on their operations. Adding to their financial distress, the company missed a $326 million interest payment in May 2025. They also failed to meet a $2 billion bond obligation that was due in November 2024, placing them in technical default. Industry analysts, including those from MoffettNathanson, have raised serious concerns, warning that the company may face bankruptcy within the coming months. Efforts to reduce this financial strain have not succeeded. A proposed merger with DirecTV, which could have cut approximately $10 billion in debt, collapsed in November 2024 after bondholders rejected the terms. On the wireless side, Dish has made some progress, achieving 75% population coverage with its 5G network. However, this falls short of regulatory expectations, and maintaining the network continues to drain resources. While Dish holds spectrum licenses that could be worth billions, selling them remains complicated due to regulatory constraints and limited time. Although EchoStar's leadership has repeatedly emphasized their focus on shifting toward the wireless market, investor confidence remains low. The company's stock is trading at around $5, and with such limited cash flow, they are unable to refinance their existing debt. Overall, the situation is increasingly unstable. Without a significant turnaround, such as a large-scale sale of spectrum assets or a major new investor, Dish may not be able to continue operating as an independent company much longer. Dish Network's collapse is like watching a blockbuster movie where the hero takes one too many risks and crashes hard. Charlie Ergen's big gamble to turn Dish into a 5G powerhouse was bold, but it sucked the life out of their TV business just when streaming was taking over. Dropping channels, ignoring Sling's potential, and piling on debt was like pouring gasoline on the fire. Now, with subscribers fleeing, cash running dry, and bankruptcy looming, Dish is a shadow of its former self. For now, Dish's story is a warning. What do you think? Can they turn it around, or is this the end of the line?